Hello, and welcome to another edition of Beaver Finance. I'm your host, Robert T. Anderson. In today's series, I'm here to talk to you about non-reg accounts, or a non-registered account. A non-reg account is simply a savings account that holds investments that requires you to pay tax annually. So remember, when you file your taxes with the CRA each year, you'll want to make sure you gather the appropriate tax information so you can properly report any income or gains that your portfolio has triggered or earned. Now, this account also may provide taxable withdrawals. So depending on the situation of your investments, if you are going to sell any investments to pay for a withdrawal, you'll want to check your gains to ensure that if you do make a withdrawal, you understand the tax consequences. So you may want to speak with your accountant on that. Next, any interest, dividends, or capital gains are taxed. Now, depending on what type of return you earn, whether that's interest, dividends, or capital gains, they're each taxed differently. So first, let's look at interest. Interest is 100% taxable. So what that means is if you earn $1,000 that year in interest, you will simply add $1,000 onto your income and pay tax at your marginal tax rate. It's the most straightforward, but it's not the most efficient. So if we can avoid earning interest in a non-reg account, that would be the best. Second, is definitely a popular situation, are dividends. Now, if those dividends are from a Canadian corporation or a Canadian mutual fund or ETF, it may qualify for the dividend tax credit. So by earning Canadian dividends, you may not actually pay as much tax as you may have received in dividends. And what I mean by that is to avoid double taxation, the Canadian tax code has introduced a dividend tax credit that tries to take into consideration by grossing up the dividends and then providing a subsequent tax credit to take into consideration the tax that corporation has already paid, since dividends are paid from after-tax income from a Canadian controlled corporation. So dividends are definitely a desired income and a popular source of portfolio income. Second, we have capital gains. Capital gains are actually the most favorable, and that is because a capital gain has a 50% inclusion rate. What is an inclusion rate? So, for example, if you have a capital gain of $100, 50% or $50 of that capital gain is actually taxable. So for example, if you were at a 25% tax rate or marginal tax rate, that $100 capital gain would have a 50% inclusion rate or $50, and at a marginal tax rate of 25%, you would only pay tax of $12.50. What a great scenario when you consider, you just had a gain of $100, and if that was earned interest, it would be 100% taxable. So definitely capital gains are more favorable. Even if you are at a higher tax bracket, switch the 25% for a higher amount, and you'll still see that it's more favorable, certainly than interest, and in most situations, dividends as well. Next, in order to file your taxes, you will receive an annual T5 or T3 tax slip for tax purposes. So any earned income, so if you work for an employer, you're probably used to a T4 that reports your taxable earnings. T4A perhaps if you have commissioned income. So let's start with the T5. A T5 tax slip, this may not be as common, but if you have a non-registered account, and whether you're a do-it-yourself investor or you do work with an advisor, you may be looking at corporate class funds. So this is the units of a mutual fund where they're structured as a corporation, which in turn has other tax benefits. Any income associated with those units of those mutual funds from the corporate class will show up on that T5 slip. On a T3 slip, which may be more common if you hold a normal series of mutual funds or, becoming more and more popular ETFs, exchange traded funds, you'll receive a T3 slip. This will outline any dividends or capital gains. So a lot of this should be done by your financial institution. So it's not something, you necessarily have to track on your own, which makes it a lot easier. Next is you get to choose your own investments from a wide range of options. This is just like an RRSP or tax-free savings account in the sense you can hold your mutual funds, you can hold your ETFs, exchange-traded funds, your stocks, your bonds, even seg funds or segregated funds. So lots of options for you. Now some bonus content for you. So thinking about asset allocation, when you're looking at different geographical areas or different stock exchanges, because of tax, you need to be mindful in a non-reg account. So typically we like to see Canadian equities held in non-reg portfolios. If you're not looking at corporate class mutual funds, simply because there are benefits, as we mentioned, with earning Canadian dividends. So for all you dividend investors or FIRE enthusiasts, those are, financial independent, retire early folks. Having a non-registered account is a good spot for you, simply because of those Canadian dividends that earn the dividend tax credit. If you're looking to supplement your income, earn passive income, it's easy to do so in a non-reg account. Certainly, look at your TFSA and other avenues first, and then your non-reg account's your next best option. Now, also, of course, talk to your accountant, simply because this will impact your annual tax return. But if you are having to use a non-reg account, you're probably in a good position already. So please like, follow, subscribe, comment below. We want to hear from you, and check out our other videos. We have videos on tax-free savings accounts, registered retirement savings plans, RSPs, RESPs, and many more videos coming out soon. Thank you for listening, and don't forget to subscribe.